Good morning and welcome back to Almus Market Mornings. Today's episode is all about taking a step back and breaking down the Indian Union budget presented yesterday. What stood out, what it means for the markets, and how the key announcements could shape growth, inflation, and asset prices going forward. Beyond the headlines, we look at the broader implications of currencies, commodities, and investor sentiment and discuss what this budget really signals for the months ahead. Good morning, JK. What did you think of the Indian Union budget of 2026?
Yeah, good morning, Sean. Uh, you know, it was not a path-breaking or anything substantially new that we saw in the budget, but it was definitely a continuity exercise focused on growth, stability, rationalization, and prudent allocation of resources without sacrificing fiscal prudence. That's what I can read the budget as. Obviously, whenever there is a budget, there's a lot of expectations from various segments of the society and the economy. And there is always scope for disappointment in this regards. But you know, definitely there are some short-term implications and the long-term implications from the budget. Short-term, obviously, for the markets, particularly which we are concerned with, equity markets were disappointed that, apart from the no change being proposed for the capital gains. In fact, there was a rise in the STT, the Security Transaction Tax, from 0.2 to 0.5%, and that actually led to a sell-off yesterday. Although it was a thin market yesterday, but still a big movement was seen in the stock index, and yeah, I think this provision can reduce the volumes in the F&O segment, and but I don't see the sustainability of this negative reaction, because eventually, what we look at and what the authorities also look at is the long-term investors approach, and the long-term investors will focus on growth, inflation, and how the macro numbers are panning out, and those macro numbers have been very good. We have had the fiscal deficit that is pegged at 4.4% for this financial year as earlier proposed, and it has been even pegged lower at 4.3% of GDP for the coming financial year, and that will be read as a very positive sign by the global investors. We also have had the debt to GDP, which is steadily moving lower. Now it is at 55.6 versus 56.1 that was seen in last year. There was some disappointment on the gross borrowings. It was slightly higher at the 17.2 trillion for this year. However, as we have seen in the past also, the central bank manages these borrowings in a very effective way, efficiently, and there should not be much of a concern eventually. Although again, there can be a knee-jerk reaction on this account by bonds being, sold, and some rise in the yields as well that can be seen. But the most important takeaway for me for the budget from the market perspective, particularly from the rupee perspective, was the measure to attract long-term investment. Government has proposed a long-term tax holiday, exemption from certain taxes for foreign companies that provide global cloud computing services using data centers located in India, and this is planned to be in place up to the year 2047. That's a 22-year tax holiday that these companies will get. This essentially means that zero corporate tax or equivalent liability in India on profits earned from cloud services. So, in addition to the tax holiday, it also proposed a 15% safe harbor on cost where data services are provided by a related Indian entity as well. So, there is a huge amount of incentive. We have recently seen media reports of many tech giants having plans to invest huge amounts in India to set up their data centers, and these perhaps were expecting the relaxations in the budget, and now that they have come, possibly we will start seeing those flows also taking shape in the coming weeks or months perhaps, and that will be a huge booster for India, which is actually been starved of capital flows. FIS have been selling relentlessly for the last 15 months, and the market has had a huge one-way move in the rupee because demand has been substantial and supplies have been very limited. So this resumption of FDI flows is something that will be very welcome for the currency market. We also had another provision where NRI limits for investing into Indian companies has been increased. Individual companies limit have been raised from 5 to 10%, and the overall NRI participation has been raised to 24%. Again, wherever these foreign settled Indians wanting to take a higher stake in the Indian companies and participate in Indian growth, there is a huge provision that can invite a lot of capital flows as well. So these will definitely deepen the Indian capital markets, attract long-term overseas capital, and improve the price discovery and liquidity as well. I also see the measures to improve the corporate bond market, improve the liquidity and price discovery processes there. So from market perspective, short term, yes, there are challenges. Stock market, perhaps we can see some more sell-off, and perhaps the FII flows will take some time to resume. But yeah, I think the medium term is very, very positive, according to me. Fiscal numbers as well as the tax breaks for the big investments in the data centers. These are very positive takeaways as far as the rupee is concerned for the medium term. And of course, we are already at elevated level in USD INR at 92 levels. And perhaps, even if there is a further move up in the USD INR, I think it's not going to be a very steep fall. We not only I do expect some containment of the weakness by RBI, but also market itself might find it not worthwhile to sell the rupee around 93 levels, because it's already quite undervalued on RER basis by about 6 to 7%. So I do expect rupee eventually to get some traction on the higher side. Of course, apart from the budget impact, we also have a week full of big events. Major central banks, including RBI, Australia, ECB, and BOE, Bank of England, are expected to deliver their monetary policy decisions, except Australia, which might actually hike rate by 0.25%. The rest of the central banks are expected to keep the rates unchanged. Once again, the forward guidance will be very closely looked at. It is also a week where US employment data will be announced, preceded by a lot of other preliminary indicators on employment, and this is one number which the market will be focused on, because any deterioration in the employment situation can lead to a dovish approach by Fed, because the inflation has been holding steady, although on Friday we did see a jump in the PPI wholesale inflation. Apart from these events, I think now that Kevin Warsh has been nominated to succeed Powell as chairman of Fed, market will be closely looking ahead to any statements from him at any of the forums to get a clue on what his latest policy or what is his latest view on the monetary policy approach is, and that will be majorly guiding the markets. But from these, of course, don't forget that we have had a very huge volatility in the commodity market, and it is still continuing. And today we have had gold, which almost hit 4,600, almost 18% drop from the high of 5,600. Although silver did not make a new low today in the global markets, gold did. But since then, it has also bounced above 4,700. I think the forced liquidation will perhaps continue for some more one or two more sessions, even in the Indian market. But I think these are levels where the conviction to sell the metals will be very low, and eventually real users of industries as well as the central banks interest will take over take over the market from these levels. So rupee for rupee, not much impact from the commodity sell-off, I think. However, market will be looking ahead to how the flows pan out in the coming days, whether FIs sell more or the last 2 days numbers have not been very bad from FI numbers. They have been very nominal, in terms of outflow or inflow. So I think a steady market in rupee, and some watch on the bond market, and of course equity markets, the correction to eventually find some base, before the long-term investors return. Thank you.
Thank you, Jairam. So, and just to summarize, nothing substantially new seen in the union budget, and it just seemed like they are sacrificing their fiscal prudence. And equity markets were disappointed with respect to no change in the capital gains tax and increase in the securities transaction tax, which saw a sell-off in the Indian indices yesterday. And maybe it could also reduce some activity in the FNO segment. Increase in FII flows will be closely watched post this budget to hopefully bring some supply of dollars in the markets and to keep the one-way move for the rupee a little stable. And we have an important calendar this week as we have the RBI, Bank of England, ECB, and also the Australian Central Bank who will have their monetary policy meetings and also have a roster of US data with respect to its employment. And volatility continues in the commodity market this morning, seeing the forced liquidation that is to be continued in the commodities for now. Thank you all so much for listening. I will catch up tomorrow with a fresh round of updates.